For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you, Brandy. I appreciate it.
So September ended up being not so friendly to financial markets. Should investors have expected that?
Well, overall, the market conditions are pretty favorable right now, but we have the seasonality factor, which is, I think, what you're referencing. Throughout the year, you have different periods of time that do better than others, like the Santa Claus. They call it the Santa Claus rally, November, December, January, February. Generally, it's quite good for the market. However, September, October are generally very tough. September specifically averages down 0.5%, so 0.5% as far as for the month. This past month, it was down 5%. So this is the year's been quite good, but certainly September was a pretty rough September.
All right. So given the heightened levels of volatility, what are you watching to help provide some direction?
So tracking and trying to read volatility as far as what it actually means is an extremely difficult thing. I brought along a nice slide here. I hope that helps people visualize what I'm about to walk through. Probably one of the main items as far as is to determine this is we talk about implied volatility versus realized volatility. And the chart is showing here, we've got three circles as far as on the top that are illustrating as far as the peak in volatility. An important note, which is on the slide as well, is the average drop once the peak has been hit has been roughly 7% as far as the decline. If you look at the very far right, you see another circle sitting over there. That one was just what took place as far as in September. This one we saw a 5% drop. So we're asked oftentimes as far as does it look like and does it feel like, that we're beyond this? And the quick, simple answer is we're probably not beyond this. The markets are still extremely volatile. We're seeing huge moves day to day. And again, a 5% drop might put in a short-term bottom, but certainly not a long-term bottom.
All right. So tell us, what other risk should investors be watching for?
Well, I think the biggest is that the easy money, we believe, has been already made. So individuals should be focusing on, I think, what we're focusing on, which is the economic growth trajectory, as well as earnings, and finally the liquidity. And so the Fed, the Treasury, as always, are a big important variable as far as in these discussions. And we just emphasize to people that, again, it's been a fantastic run that we've had. Again, don't get too crazy as far as at this part of the market cycle.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.